to Michelle, to Filippo, to Mustafa. Once again, we are meeting up quite often for this project. And I understand that for different countries among Latin America, the equity method project is very important. And well, we are open to hear from you, your views, your news, and the main aspect of the project. Then the floor is yours. Thank you.
Okay, let me try to see if I can share.
Oh, Felipe, if you want, I can share. It's up to you.
Okay, maybe it's better so this way I don't have to.
Yeah, you can concentrate on 1 second. Despite I offered, I wasn't prepared. 1 second. I had that one. 1 second. Okay, here we go. Okay?
Okay, yes, if you can just move past the, okay, this one. So basically the exposure draft that was published in September covers, I would say, quite a wide range of different topics. So I suggest that I very briefly indicate for each topic what are the main decisions, and I can also say what are some of the feedback that we are hearing. This is a project that, as Erno was saying, depends a little bit where you are. In some jurisdiction, there is not a lot of attention for the equity method. In some jurisdiction, it is quite used. Some of the proposals are, for some people, what they're already doing, so they are not particularly worried about it. But for some jurisdiction, some of the proposals are different from their current accounting practice. So the feedback that we are hearing, it's really a little bit mixed and depends from well, basically what people are doing in that specific country. So if we start with the first topic, this is about the initial measurement of an investment in an associate or joint venture. So basically IAS 28 says you use cost, but didn't say anything about how to measure the cost. The board has taken some decisions about how to measure any prior interest held in the associate. So if I go from having 5% to 20%, what do I do with the original 5%? How to include any contingent consideration arrangement in the measurement, and whether the investor should consider the deferred tax effects linked to the use of the fair values of the share of the associate net assets. One thing that the board has not addressed, and I think this is probably the most consistent feedback we've received, the board has not taken any decision on how to account for the transaction costs, like legal fees incurred in acquiring the associate. There is an old 2009 IFRIC decision that was said, well, normally costs include those transition costs. But because some of the decisions have been taken, but some of the proposals are more aligned to IFRS 3, and under IFRS 3, transaction costs are expensed. People are asking whether, I mean, the definition of the cost implies that transaction costs should also be expensed. So this is, I think, something we will go back to the board and ask the board to take a decision. Obviously, if you go the IFRS 3 direction, this would be expense, but we're also hearing some initial, let's say, conflicting views about what would be the recommended treatment. So maybe I can stop here and I can start to hear if there are any questions or comments on this part of the proposals.
Thank you, Filippo. anyone have some comments?
Me, Hernan, thanks.
Yes,
Good
Oscar.
morning. Yeah, good morning, Felipe. Well, in terms of the question one, measurement of the cost, we definitely, as a group, welcome the proposal of you guys adding the definition of what actually the definition of the cost of investment is. But as Filippo mentioned, we also tend to recommend that this definition needs to be further expand a little bit more, because and actually mention what is the correct treatment of the acquisition related costs. And we came to this conclusion for two reasons. The reason number one, other IFRS like IFRS 9, IAS 37, and other IFRS mention what actually comprises the cost of any, let's say, financial instrument or whatever. This is the reason number one. And reason number two, as also Filippo mentioned, this equity method exposure draft is kind of in alignment with IFRS 3 when it comes to the recognition of the contingent consideration. But also, we notice that IFRS 3 mentions the treatment of acquisition-related costs, which is in paragraph 53 of IFRS 3. So definitely we think it'll be helpful for users to actually know what is the exact treatment of the acquisition-related costs. So if part of the exposure draft is also reduce the diversity in practice, maybe you guys want to take this recommendation into account when drafting the final version of the IAS 28. So this is the recommendation we have for question number one. So thank you, Filippo.
Can I ask a question? Do you have like a direction? What would be, I mean, your suggestion in terms of how to treat those acquisition-related costs? Would you go the IFRS 3 approach?
Yeah, I think the direction or the main objective of us suggesting this recommendation to you is basically to have a IAS 28 standard that clarifies the correct treatment of the acquisition-related costs. And what I meant by that is the acquisition-related cost should be treated as an expense or should be part of the cost of the investment. So we think, at least in Latin America, for us, it's really helpful to have a specific direction of the treatment, so everyone can take the same direction and avoid diversity in practice. That's our main recommendation, Filippo.
Okay, thank you.
Oscar,
Thanks to you.
just to be clear about the position of the group, do you have any preference about the treatment? If the cost should be expensed or should be capitalized in the current amount of investment?
Well, as I said, Hernan, our preference is not, we don't have a specific preference, but we would like to see in the standard written, the acquisition-related costs should be expense, or otherwise, what would be the treatment? So whatever the decision is, I think we are in agreement, whatever the decision might be, but what we are asking is that treatment is clear in the standard. That's what I meant.
I think what he's saying, Hernan, is the group needs to refocus on that and make a recommendation. They need to do that. I think, Carmen, am I correct in saying you have not concluded what the best approach
We are
is
not
yet?
conclude about that,
Okay.
just we only talk about and we want to clarify
Okay.
the writing of the IAS 28 about this issue.
But I think before we finalize our letter, Hernan, we need to come to a conclusion. So that's the focus we need to work on. It's a little early, Felipe. Often we're a day away from sending the letter when we have these meetings. This one's a month away, so we have a little time left.
Very good. Well, I mean, unless you want to spend, I hope you don't spend your Christmas holidays writing the letter. Okay, so maybe I'll go to the next slide. The next proposal concerns the accounting for purchases of additional interest. So I've already obtained significant influence. I buy an additional 5 or 10%. And this is something where the current IAS 28 has no requirements, and we know that there are different accounting practices. So in terms of feedback that we have received, I think the comments we heard, I mean, again, mixed views. But some people have raised some concern about the use of the fair value of the additional share in the assets and liabilities. And I would say that the objection is more like on a practical basis. So people have said there are cases where maybe you buy a very small additional share, or maybe you have a number of purchases over a certain period of time, and using all the time these new fair values is determining the fair values can be quite costly. Obviously, the logic is that, I mean, on day one, you wouldn't have a difference because the amount of the purchase would be the same. This impacts the future calculation of the share of profit and loss. Obviously, we don't want people to do this kind of exercise when the impacts are not material, but we understand that people are saying that, I mean, I thought that the normal materiality filter would be enough, but apparently people are saying, well, you should consider some kind of practical expedient on how to do it when the facts are not material, and this is something we may think about. The other comment we've heard, I mean, we say, well, once you have determined this share of profit, the share of net assets, the difference between the price paid and this amount is treated as a goodwill, or is a gain from a bargain purchase. And we have heard some comments from people that would prefer that if there is a gain, this is directly offset against any prior goodwill. This was a little bit of a surprise for me because, as we know, in theory, bargain purchase gain should be something that happens quite rarely. But, well, apparently this is something that can be happening in some jurisdictions. So in those jurisdictions, we heard rather comments to offset this bargain purchase gain. The decision why the board decided to treat it as a bargain purchase gain was that the view of the board is that when you purchase an additional share, this is on that moment a separate transaction. But again, so some people have commented on the bargain purchase gain.
But we're happy if you don't want to comment, that's fine. We had a long conversation on it this morning. Yeah.
Well, some reactions about the explanation of Filippo.
No, Hernan, we're okay.
Okay.
It's okay for us.
Maybe trying to understand the point, Filippo, during your early feedback, you hear from stakeholders that they prefer to calculate the increasing amount using the same net assets, or changing the fair value of the net assets to calculate the additional.
Some people are saying, imagine that I'm buying another 0.5%. If I have to do this fair value calculation, that's going to be a lot of work and it's not going to be very different. You should let us use the amounts that we're already using for the existing interest.
Yes,
this is the kind of comment that we're getting. But obviously this works when they're just incremental. If there is a big increase and the original amounts are from 10 years ago, can be material. So that's why it's more, I would say, a question of is there a way to provide some kind of practical expedient when the facts are not material, rather than the principle itself.
But in the case that the practical experience was not included in the standard, we can find that the company could have, for example, the 40% of other company, but parts of this 40% calculate over different net assets and really fair value of different net assets, and that could not have meaningful in terms of the economic reality, maybe that could be costly and not report any usefulness for the users of the financial statement. I'm not sure.
Again, I think it depends a little bit from facts and circumstances. If you're buying something today using the cost from 10 years ago, is not something that is really relevant. So I think obviously if you bought something 6 months ago, probably redetermine the fair values, you will end up with numbers that are quite similar. So I think this is more a question of applying it in practice rather than the conceptual aspect.
That's the point. That's not conceptual, even it is practical. Well, we can go ahead.
Okay, the next is about partial disposals. So when you have 40% and you sell a piece of the investment, but you retain significant influence, here the proposal is to derecognize a portion that is a proportion of the carrying amount. So if you're selling 10% out of 40%, you simply take 1/4 of the carrying amount. I think this is what most companies are already doing. The board decided not to require the use of LIFO or FIFO or any other, let's say, specific identification of the portion being disposed. And on this one, I don't think we've heard any kind of comment.
Any comment or reaction on this point?
No. No comment.
I believe that it's very quite related to the practice that companies are following in these times. Okay.
Okay, the next one is one important proposal that addresses a question that has been open for a number of years. So other changes in the ownership interest that are not purchases or disposals. So the typical example is a dilution. The associate issues shares to a third party. The ownership interest of the entity goes down, but at the same time, the associate has received cash or whatever from the new shareholder. So the question here is how to treat this transaction. And the board decided that from an economic perspective, they see those transactions as similar to similar to purchases and disposals. Therefore, the treatment should be the same, which means that for dilution, there will be recognition of those dilution gains and losses in profit or loss. Okay, so in terms of comments that were received, I would say there is one specific country where they have a different accounting practice right now based on local regulation. So they consider these to be recognized, these gains and losses to be recognized in equity. And so therefore, this will be a change to their local practice, and they do not necessarily agree with that. And I think this reflects a little bit of the feedback that the board received back in 2012 when they issued an exposure draft, and there were approximately 75%. At the time, the board was suggesting to treat those as equity items. And at the time, more or less 75% of the respondents disagreed because they thought that they should be accounted for in profit or loss, and 25% of the respondents agreed with the treatment in equity. So I think there are different views, and this is reflected by part of the feedback. The other feedback that some people, especially I would say accounting firms, have raised is that there are other fact patterns that the board has not considered, like for instance, your associate is a group and the subsidiary of the associate issues shares to third party. In this case, you would have a change in the consolidated net asset of the associate, but you wouldn't have a change in the ownership interest of the investor, because the investor is invested in the associate. I think that the board, when the board debated, I think we wanted to address the most common fact pattern without trying to fix all possible fact patterns. I think that it will depend from the feedback I will receive. If a lot of people raise issues about specific fact patterns, we may want to consider them, but obviously the more you try to fix different fact patterns, the more complex the proposals may become. I don't know if Michelle, you want to add something?
The only thought I've possibly had on this, and what one point of feedback we've had, which I think Philippe and I have conceded to agree, was, you know, the way we approached this project was to answer an application question and then another application question. And I think in some instances we might have dropped down too low. You know, we might have tried to answer a question in too much granularity, and what we would have been better to do was implement or propose a principle. And I think perhaps this is an area where we wouldn't want to go into any more granularity, because Philippe is right, it's just another fact pattern. But maybe we could have thought about, rather than this being so specific to this, it was more of a principle. And I'd be interested in thoughts on that area.
Thank you, Philippe and Michelle. Any comment, reactions on this point? Just maybe if someone is thinking the comment, I have one, how these requirements interact with the requirement about the different purchases on different bases. For example, if an investor has 20% of an associate, and then the same investor purchase another participation, for example, a 10% additional to the 20 initial, and has the 30%, and then dilution effect took place. The dilution effect is applied in a proportionate base on the two components of the same investment, so has a different effect on the same assets.
When you have a dilution, you treat it as disposal. So let's assume you had 30%, and then there is a dilution that brings your investment, your ownership interest down to 25. Right. You basically treat it as if you were selling 5% of your investment. So you will recognize 1/6 of your carrying amount, but at the same time, you will also recognize the share of the money that has been paid by the new shareholder. We have I think, a numerical example we have an illustrative example in the exposure draft to show how to calculate this dilution gain or loss.
Yes, I understand the point, but in this case, the dilution effect should be calculated using for example, a FIFO approach regarding the first component, or in a proportionate approach, taking into account the different bases of the two components.
No, I understand what you mean. No, that would be in practice, although we didn't call it like that, that would be some kind of weighted average. The layer approach works only on the data to purchase. After that, you're treating like a single asset, so you would have some kind of a weighted average in the calculation.
Okay. Yes, because the fact patterns of different cases could be very, very long, and principle seems to be the more efficient to resolve that in practice. Yeah. Okay.
I think the board were really trying to be practical, because when because we have had some feedback about there's an inconsistency between the layered approach on initial recognition and then how you account for the investment and on disposal. But I think the board were really trying to be practical and say, if we ended up extended the layer approach, it would just be too complicated because you would be trying to, impair individual layers and things. And anyhow, once you own the investment, you manage it as a single investment. So I accept there's a bit of conceptual awkwardness, but I think it's a reflection of the board trying to be practical and balance costs and benefits.
Maybe in order to be transparent in the financial statement, some requirement to disclose the rationale that companies follow to solve these different practical expedients should be required. Maybe modifying the IFRS 12 or indeed into the IAS 28, because that could be very important to understand how the management prepare the financial statement. That I understand that using IAS 1 and IFRS 18, the rationales to prepare the financial statement should be stated clearly in the financial statement, but the general requirement could be little to improve the behavior of preparers in this point.
Okay. I'm very happy to see your suggestion on how we can provide better support. I think that's because one of the purpose was to make sure that we have the disclosure that allow people the users, the readers of the financial statement to understand the accounting. So if there is something that can be improved, we're very happy to read that. Okay.
Well, if no comments, we can go ahead.
Okay, so this one is a tough one to explain in words. We have an illustrative example in the exposure draft. But basically what happens is that there is this requirement on one side to recognize separately the investor share of profit and loss and the investor share of OCI. But there is also this requirement that when the carrying amount has been reduced to nil, the investor should stop recognizing losses unless there is a legal or constructive obligation. And so two questions were, the first is, imagine you have a carrying amount of 100. The share of profit or loss is negative for 60, and the share of OCI is also negative for 60. So the total is 120, but you can only take 100. So what is the order of recognition? And for this question, the board decided that you should start to recognize the share of of profit and loss, and then move to the OCI. And the other one is that imagine you have reduced to nil your investments, and a year later you have a positive share of profit or loss of 20 and a negative share of OCI of 30. And we understand that right now some people take the two amounts, 20 and 20, and some people don't do anything because they offset each other. And so the board decided that, well, users still consider that having the separate indication of these two components may be useful because they may have a different quality in terms of information, the P&L and OCI. So the board decided that you should present separately these two components to the extent they do not put the investment in a negative position. What the board has not done is instead to indicate what should be the order of recognition if the entity restarts to recognize profit because the new profit have offset their recognized losses. Some people think we should be complete and also add this piece, but well, I would say that this is area probably has not attracted the most interest in the project. we have not heard a lot of comments on this one.
Any comments or reactions at this point? Carmen? No. Ah, okay.
No, Hernan.
No
Carmen.
comment.
Well, I understood when I read the project that it is a clarification on the current practice rather than a new into the procedure that companies usually apply in practice. That's okay.
I think that, again, this was mostly raised, I would say, from auditors. I said there were different views, but again, I don't think this is one of the most important pieces of the project, probably.
In general, in countries where the equity method is applied in separate financial statement, this point could create a big difference between the results in the separate financial statement and the result of the parent or attributable to the parent in the consolidated financial statement. But we are living with this during many times, then I believe that this is possible to afford.
Okay. So shall we go directly to the eliminations and then we can discuss also separate financial statements? Because I think this is probably
the hot topic.
more important than the P&L and the OCI. So maybe we can move. Okay, so as I say all the time, I mean, all the other proposals in the exposure draft are basically filling gaps and introducing requirements for things where the standard was not saying anything. But this is a change to the existing requirements. And the reason why the board went their way is because it's important to understand why the board was doing this. There is this perceived conflict between IFRS 10 and IAS 28. It has been there for 15 years, more than 15 years. There were these 2014 amendments that were issued, but they didn't have any effective date. And so basically the conflict is that IAS 28 says to take only a portion of your gain and losses in transaction with associates, and the rest is taken when the asset is transferred or the asset is depreciated. But IFRS 10 says that you take the full gain when you lose control of a subsidiary. And the question was, okay, if a parent transfers a subsidiary to an associate, do they use IAS 28 or do they use IFRS 10? And this is something that the board definitely had to fix in these projects. And after discussing with users and preparers, and also with some conceptual arguments, I can explain them, but they are quite spelled out in the basis for conclusion. The board has decided to propose that all gains and losses are recognized in full in those transactions. The feedback so far, again, I would say mostly positive, but obviously this is a change, and I understand that some people are a little bit reluctant when you change financial reporting requirements. And the kind of comments we've heard is mostly about this could open some possibilities for earnings management, especially in transactions with joint ventures. The other point is that, and I can already introduce the big topic, is that the board decided that all the proposals also apply in separate financial statements when the entity uses the equity method for subsidiaries. Obviously, this will create a difference between the consolidated financial statements, where the intra-group gains and losses will still be eliminated, and the use of the equity method for subsidiaries in the separate financial statements. This is an issue I understand that is quite important for Latin America. In other countries, they don't use IFRS for separate financial statements, or they don't use the equity method for investments. India, for instance, has even taken out the opportunity to use the equity method for separate financial statements. But again, I understand, obviously, it creates a new important difference between separate and consolidated financial statements. The alternative would have been to create different versions of the equity method, and I think the board did not feel that it was the case to have different versions. I don't know, Tadeo, obviously you may want to comment since you have a dissenting opinion in the exposure draft.
Nothing like putting you on the spot today.
No problem. Actually, I'm here to hear the guys from GLENIF. Actually, what I have to say is written. It's there as an alternative view, but we know that the one thing that I have been learning in this outreach is that Latin America is not alone. We have friends.
Yeah, that's been a learning point for me. That's what he says, because even I've been shocked. Apparently, some European jurisdictions use the equity method in separate financial statements. I cannot understand why, but because Europe has before Europe had IFRS, it had a European accounting directive, and it was never in that directive. So.
Any comment about this point?
We have many. Jose or started?
This was an important discussion into the group, okay? The difference is very important in Latin America because in Venezuela, for example, one position is not agreed with that improvement into the IAS 2028. I don't know if into the IASB can analyze to maintain the position to the share of assignment of income to the spending over the investment. Okay, in Venezuela, preferred alternative suggest to Tadeo Sendon, for example, to maintain the treatment. Okay.
Well, in our discussions, we talk about this issue, and really generate some concern because the new treatment that the project proposed, it's based on in particular situation when the investor or joint venturer sell their share on the subsidiary. It's a particular situation that carry a very big change in IAS 28. So some of the we thought in the group is about that why not maintain the actual paragraph and write another paragraph as an exception, in particular that the situation that the project presents as an exception for this situation in consistency treatment with the IFRS 10. We really, because all the problem is about this situation, and this situation carry to a big change, and then they have an effect in years 27, sorry. So it's, or we have, we take care about this situation in years 28, or then we have to take care in years 27, because in Latin America, it's we have situation that the legal treatment is about to apply years 28. And then it's another thing that this treatment, for me, it's a personal opinion, that open a possibility that the investor or the joint venturer will do earnings management. So I am concerned about this issue. Sorry, boy, but my English.
I mean, obviously this is a change. I mean, a few comments. The 2014 amendments were never finalized because at the time the feedback, I was not in the IASB, but I was following this debate. At the time, the feedback was not very positive, and people were saying that making this distinction between transfer of assets and transfer of business was debatable from a conceptual perspective, why you should do different things when you lose control of something, when you lose control of an asset, or when you lose control of a business. It was creating also structuring opportunities because you could put some assets in a subsidiary and then sell the subsidiary, and based on the structure, the legal structure, you would have two different outcome. And also some people are saying, well, yes, it's true that the board has added all this guidance in IFRS 3 to make the distinction between an asset and the business, but that's guidance is quite burdensome. So having to apply the same guidance when you sell something, it's also complicated. So, I mean, if it was an easy solution, it would have been already there for 10 years. So that's why I'm saying this is something the board considered, but decided not to go to. But what I want to say is that leaving things as they are today, I don't think is an option, because this has to be solved after 15 years. The three ways are to either change IFRS 10, but there was a post-implementation review not 2 years ago that was completed with no change, or change IAS 28, or take again those 2014 amendments and try to finalize them, but again, with some problems attached to them. The part on earnings management, I can be a little bit, cynical. Well, if you have 20%, 30% in an associate, today you can already manage 70% of the gain. So I'm not really sure that, I mean, if this is really
not 100%, Philip, but not 100%.
No, but okay, that was just a joke. But what I'm saying is that if this is the real issue, is about those gains are not genuine, then I wonder if the answer would be not to recognize anything at all and have some kind of commercial substance test on all these transactions. But then it's completely, but I mean, the fact is that, okay, so it's okay to recognize a piece of these gains because it's okay to do earnings management only for this piece. I don't know. I'm not really sure that I find it very persuasive. But again, I think.
But I think there's two questions, and I think we need to be careful not to conflate the two questions, not to combine them, because one is: do you agree with the amendment that we're making to IAS 28 regarding changing the requirement to not eliminate, which is how the board looked at it, because the board answered that question first. Then it secondly asked itself the question, does this apply in other sets of financial statements? And it decided the board decided it didn't want two equity methods. So I think in responding to the exposure draft, what would be helpful for us is whether you agree with eliminating the eliminations or whether you disagree with it, and then whether you agree with the board's subsequent decision on separate financial statements, because that's why this presentation is presented like this, because that's how the board approached the project. It sorted out the application questions, answered the application questions in relation to associates, then said, can we apply these answers to jointly controlled entities? And then said, can we apply them in separate financial statements? And I think what I hear from yourselves is it's when we're applying the equity method in subsidiaries in separate financial statements that we disagree with, which is perhaps different to when the board made the decision to eliminate the eliminations for associates.
But this decision for the board is based on a particular case, not its general. That's our concern about that, because it's not a generalized this situation. The question number 4 based on a particular situation. So we ask, why is a particular situation carry this decision? Why not maintain the actual paragraph and then added a new paragraph with this exception? Sorry, that's
well, and I think that's what I'm saying. I think when you answer question 4, you could say, okay, we understand why the board is eliminating the eliminations for associates and joint ventures. But then when you get to question 8, you might say, we disagree with
I think what you're saying there would be, sorry, if I understand your position, is more we should keep the eliminations for transfers of assets, but we should not, and we should have the IFRS 10 treatment only for transfers of business. So you're more aligned to the 2014 amendment. That's what your position.
Yeah.
Okay.
Yeah.
Okay.
Yes,
Yeah.
because for us are two transaction, different transaction, and it's better to maintain the treatment and separate the only transaction that suggests the improvement of the IFRS. IASB.
Tadeo?
First, I think that it's what I heard from Carmen exactly as Filippo has just said. I mean that, and Michelle is right. I mean about separate the discussion about the separate financial statement. Here we are not discussing separate financial statements. The position of the group seems to be that we should keep the elimination and try to solve the inconsistency between IFRS 10 requirements and IAS 28. But it's one thing that I heard from Michelle, and I thought that it was a very good advice, is that, and she said that during the WSS, is that please read the base for conclusion. I did not forget, because actually, even myself, my first reaction would say, no way. But when we start going through the process, and we started answering the question on how can we sort this out, this inconsistency between IFRS 10 requirements and IAS 28, one thing that we decided is that it is that associate is not part of the group. Why should we not recognize the entirety gain? For example, if I sell a subsidiary, and because we have to go in one or another direction, then the direction was, yes, you have to follow IFRS 10 and recognize 100% of the gain. And then the second question was, what's the difference between selling a subsidiary, selling a fixed asset, or selling inventories? I mean that, why in one case I am recognizing 100%, in other cases not? Because in the end of the day, the concept is the same. The associate is not part of the group. And then I did not disagree with that. But you are completely right. I mean, that the original question was the inconsistency between IFRS 10 and IAS 28. But as we need to be, and we try to be as consistent as we can within the standards, that's a difficult question to answer. Why here I'm recognizing 100% and there I have to retain part of the gain? That's why we decided that, and we also heard from users, something that's important to say in this group here. Users told us they found this retaining, not recognizing 100% of the gain, or retain. Let's say that you have 25% of associated, and then you sell and you recognize 75% of the gain. and retain 25%. I mean, for the users, it's quite messy, quite confused, because they need to understand that this 25% will come in the future. It doesn't represent necessarily cash. Most of the time, you can imagine for them trying to track this in the following years. I mean, that users told us, no, I would prefer that you recognize the year that you have the transaction, the entire gain, and tell us that you did it, the transaction, the terms, and etc. I mean, that even from the user's perspective, they would prefer that we allow the recognition of the entire gain. That's the rationale to be where we are. I mean, I fully understand. I mean, that is a change in what we do today, and then it's always very disruptive. But if we just have a quick fix for the IFRS 10, but we keep as it is for the other transactions, and then in this case we have an inconsistency within the same standard. I mean, that why here I'm recognizing 100%, and for that other transactions, I heard you saying, Jose, that it's different. It's subsidiary, fixed asset, or inventory. I don't see that as an asset. That's the point. But I'm just telling you why, as a board member, I agreed with the conclusion we reached. I mean, that is a rationale. That's why I referred to the base for conclusion that I learned from Michelle, that this is a project that we do need to read the base for conclusion, because if we just pick the ideas, some of them are difficult to digest, but the moment that we start understanding the rationale for each of the individual decisions, we realize where we are, except for separate financial statements.
Well, you can understand the rationale, but you can disagree with it.
A very good seller.
Tadeu, just to clarify the point, my understanding is that the group in class that is analyzing this point disagrees with the fact that the origin of all the discussion related to the transactions and the elimination of the intragroup transactions is this point. And the thought is why, from a particular case, we create a general solution for all cases. Not the discussion about if in this case it is a good point or not to modify IAS 28 to 28, yes, for required to eliminate or to recognize in full this gain or loss for the disposal of the subsidiary. But this case is particular, and we are creating a general rule to solve a particular problem. That is the point. I understood this point, but not sure. It's okay?
I think in English we would say you're taking a sledgehammer to crack a nut, is what the feedback I'm hearing. Is that right?
Okay.
I think...
in Portuguese would say that we are trying to kill an ant with a bazooka.
Yes, trying to kill a mood with a bazooka. Yes.
Well, we don't kill animals. We just crack a nut. I guess that's. I think I would agree with what Tadeu has said, that in the basis to answer this application, we looked at what we were trying to achieve with this information, and we did decide actually we could answer the question. And actually, if you look at the equity method and you look at the structure of the group, we eliminate transactions when we're applying IFRS 10 because we're looking at a single economic entity, whereas when we apply the equity method, we don't have control. So we questioned why we were eliminating transactions when we didn't have control. And so there was a lot of conceptual thinking that went on. And then on top of that, we did a lot of discussions with investors. And, you know, investors, I think I would say most investors supported being able to have the transaction and not have the noise of the unwinding of the unrealized proportion in future years. So a lot of investors didn't really understand the equity method to that extent. And then when they realized they were getting these elements of profit coming through in future years, they were like, no, it would be better if we just saw the whole thing. So I think there was quite a strong, I think we did a lot of research and we thought about quite hard about why eliminating the eliminations was a good step forward. And we did see that it would simplify application of the equity method. But and that's why I think I would try and answer the two questions separately. Do I disagree with eliminating the eliminations, or do I think we should do something different when we get to separate financial statements?
As a last comment, the proposed solution has also another advantage, which is to get rid of a number of other questions.
Yeah.
Like, for instance, something that I remember from my days of an auditor. What if you have a portion to be eliminated of a downward gain that is higher than the carrying amount of the investments? Do you only eliminate a part of the portion that puts the amount to zero, or do you make the investment negative? Or also other things like, how do you eliminate the portion in an upward transaction? Do you charge it against investment, or do you charge it against the asset that has been sold from the associate to the parents? So this decision, if you look at the basis for conclusion, you will see that the proposal from the board to drop the eliminations, and again, let's leave aside for a second the separate financial statements, but the decision, the proposal solves another number of outstanding application questions. Again, I think putting together the input from users and yeah.
Listening to you, perhaps the way that the question 4 it was written is not the best way, because your focus in particular situation not in the opinion of the users and the other. Perhaps it will be better to understand this question and then to answer it.
Okay. That's a fair point.
I think,
maybe we have given too much. This was the starting point, but it's true that the discussion evolved a little bit. Maybe
I just wonder, actually,
yep.
I asked Mustafa develop these parts of the exposure draft, and I asked him to join the discussion this afternoon, and I don't know whether Mustafa wants to add anything.
Yeah, I can just add a couple of points. In the basis for conclusion, we listed all of the application questions. So for transactions with associate, I think you can find about 7 or 8 other application questions about the transactions with associate. And when we started to work on this group of application questions, we started with the big one, related to 2014 indefinitely deferred amendment. As Filippo mentioned, that the board has been trying to resolve this issue for more than 15 years. And it didn't work just to try to address it in a piecemeal. And as part of the project, we started to look, we started to step back or to stand back and asking ourselves, what is the role of the elimination? And we started to dig more about it when these elimination requirements has been introduced to the standard. So I think part of my research, I tried to look at the history of IAS 28 since it was established, I think from 1989, following up all of these kind of requirements, when these requirements have been introduced, and the reason, all of these kind of things. And we tried to break down the issue to different bits and pieces, and then we tried to aggregate again the conclusion for that, and we ended up as Michelle mentioned that, yeah, perhaps in the past 20, 25, 30 years, the views were a little bit different, how to look after the associates, but now after IFRS 10, IFRS 3 and conceptual framework, and now the control is the fundamental principle to be used to draw the line or the boundary of the group or the reporting entity, and after the BIR as well. So now we have a lot of evidence that, as Michelle mentioned, that the associate is not part of the group for this kind of boundary. So this is how we try to break down this question, and we didn't find any choice. We wanted to look at the main role of this elimination first, and we ended up with the conceptual arguments. We should not have the elimination anymore on these kind of things, on top of the preparers and investors' feedback. So once we decided with the board to eliminate the elimination entries requirements, we had still the other 7 application question on hand, but basically all of them have been automatically resolved because we decided to take out the elimination, i.e. to full recognize gain or losses. And all of these kind of things already were listed out. Yeah, we have the list of the application question. And once we started the elimination entries requirement discussion in the basis for conclusion, we in some paragraph, we said that we started to look for all of these holistically. And once we decided to take out the elimination, all of the other already have been taken out. But I think when we drafted the question and invitation to comment, it was quite difficult to combine all of these kind of things in just a question 4. So we started with the main or the bigger question, and we had the reference to the specific basis for conclusion, which cover all of the points or discussion that I have just mentioned. So hopefully this would clarify how we address this question and why we landed to that direction.
Carmen, do you want to stress something? No?
It's okay. Okay for me.
Okay.
So yeah, this is the first angle in terms of the history or what did we do to take out the elimination. And when it comes to subsidiary, I think we did receive some pushback not to try to touch or to address or to discuss the separates in a holistic way. But I think as a team, we decided to have that in our papers and also in the basis for conclusion. So when it comes to separate financial statements, we didn't say just apply the same equity method. We tried to address the question from different angles. So we started to discuss it from types of financial statements and the concept of control in IAS 27. And it is not new. I think there is now basis, I think paragraph basis for conclusion number 7 in IAS 28, which made it clear that the IASB made a distinction between concept of control and separate financial statements and concept of control and consolidated financial statements. So in separate, the board said that the investment subsidiary, it was just equity in instruments as an asset under the parent control. So in separate, you don't control the subsidiary, you control the investment as an asset, as an equity in instruments. And this should be similar to associate and JV. So when it comes to separate, concept of control as a control of an asset as like the associate and JV. And the board made it clear in BC 7 of IAS 27 that this is completely different to concept of control when you are talking about the single unit of account, parent and its subsidiary. And this is first, I think this is one of the arguments that we used when we decided to maintain one equity method and separate financial statements. So this is our first technical argument. And the second one, we started to look about the history when the board decided to reintroduce the equity method to separate financial statements. There were a number of differences discussed at that time about the borrowing cost, about the impairments, about the continue recognizing losses, all of these kind of things. So yeah, I have to say that these proposals would increase these differences. So if we had, for example, 4 or 5 differences in the past, now we have 8. And it is not about only elimination. I think in terms of the acquisition for the additional purchase or even on obtaining significant influence, it could cause some more differences in separate financial statements. So second part on the basis for conclusion, we discussed in a good lengthy about the history, and also we discussed the application of equity method in different jurisdiction. We had an outreach with, I think, CBC and GLAS before issuing the exposure draft, and also we had an outreach with some other jurisdiction like Korea, Italy, and India about this. And what we found that the objective of the separate financial statements is a little bit different amongst the jurisdiction or countries. And there is diversity in practice how people look at the equity method in separate financial statements. And one of the points that the board acknowledged that this proposed requirement could increase the differences, but the issue is not brand new issue. It was existed since 2014, I think. And we try to combine or to aggregate all of these broader questions about the relations between general purpose and separate financial statements, and the board felt that this could be something within the boundary of IAS 27, not IAS 28. So yeah, sorry that I wasted your time a little bit. I just wanted to explain more, as Tadeo mentioned, for the basis for conclusion, what we had for elimination, what we had for separate financial statements. And sorry again for wasting your time.
No, thank you for you.
Thank you, Mustafa. I don't know if we start with a discussion on separate financial statements or if we have other topics related to the procedures on the equity method, Filippo, or?
Well, I think this is all of it. I mean, I think that the next block of decisions is about impairment, transition, and the transition requirements. So, I mean, if you want to start discussing the part in separate financial statements, please go ahead.
Okay. Well, just to begin, I'd like to say that I understand the technical basis of the decision that Mustafa explained, but my point is that we can coexist with differences between the consolidate and separate financial statement, but this case is quite different because we are talking about an opportunity to manipulate figures, because the older differences arise from the treatment of, how to say, natural topics when you account for different elements on the financial statement. But in this point, we are talking about transactions that a company could organize many times with subsidiaries to manipulate, to manage earnings. And that's why my perception is that it is quite different of the other differences that we have when applying the equity method and the IFRS 10 to consolidate subsidiaries. That is my big concern, not having differences because, as Mustafa explained, we have a lot of differences between the separate and the consolidate financial statement. But this is an opportunity to play with the differences. That is my concern.
That's a good point. Can you just elaborate to us more about how does it work? So, was it just a simple example just to convey this?
Yes, I can give you one. For example, a parent has a subsidiary, has the 100% of the subsidiary, and the owners of the parent company want to create artificially dividends to justify, I don't know, anything, and they can create a saw to the subsidiary, to the parent company with a great margin, and create results in the subsidiary to distribute earnings to the parent company, and the parent company be able to pay dividends to the owners of the parent company. And for example, if we're talking about companies in different jurisdictions, that could create an opportunity also to manage the tax opportunities on those cases, because in some jurisdictions, for example, dividends could not be taxes, and in other jurisdiction maybe yes. And creating this situation, we are giving a lot of tools to create opportunities to creative people. That's why I believe that I don't find any advantage, but I have a great point to avoid this change in the standard.
Yes, because in our jurisdictions, the decisions take on the separate financial statement. So in this case that Hernan described, we have like an earnings management that I talked about earlier.
I understand where you're coming from, and again, I think there is a more general point about the meaning and the use of the separate financial statement. But I mean, there are different ways you can do also if you have the eliminations, because for instance, you may charge your subsidiaries management fees, and it's also, you can create a profit like that, and this would not be captured by the equity method eliminations. And also, I mean, you may have companies that use the cost method for their subsidiaries in separate financial statements, and they would not do the eliminations in their separate financial statement for transaction with subsidiaries. So I'm not saying I understand the issue you're raising, but I'm just wondering whether this is a more general conversation about what is the purpose of the separate financial statement, and I'm not really sure that this is something that we can really address comprehensively in the context of this project. Again, certainly the implication for the separate financial statements is a big point, and definitely it will be part of the deliberation. I'm not really sure how we can approach it. I'm not really sure that we can just put an exception like that in IAS 27 says use different way. So we have to think about it. Certainly we understand it's quite important for Latin America. But again, I got the impression that the point that are being made point out a more general discussion to be had about what is the separate financial statements, how you apply the notion of control in separate financial statements, is it subsidiary part of the reporting entity in a separate financial statement, or it is just a financial asset? If it is just a financial asset, maybe it should be fair value to profit and loss. But I think it becomes a really much bigger conversation. That's my impression. So it's going to be difficult to find a way to say, okay, we can just fix it like that in this project without, I don't know, that the really initial reaction. I understand the point, but.
And thanks for that, Filippo. I think this is a good example. And just if you can just allow me to take on this more, I can understand that your concern is having, for example, downstream transaction with excessive profits. Then you will be eligible, for example, to distributed profit. But think about it a little bit. So whether the subsidiary will settle this balance, or this balance will stay as a receivable from the subsidiary, and for how long, And if you can just do one transaction, but you cannot do a multiple transaction having these kind of receivable, you will not have the money to make distribution if you just try to build up the receivable forever. And if the subsidiary is going to settle this transaction, if you eliminate it or if we restricted the gain to, for example, 75%, the cash that you are going to collect from the subsidiary, I think, will be higher than the transaction value. So it will be a debit side for the subsidiary as cash collected in advance for something that you restricted. Just I started to think about it, not on the day one of the transaction, day two, and upon settling these transactions.
Mustafa, I think it's important that we make the distinction. I mean, capital distribution rules and capital maintenance rules are really set in a jurisdiction's legislation because they're quite often part of economic policy. And so therefore they go beyond really our financial reporting. So, you know, what we say is we're talking about general purpose financial statements. And I take the point that you could do a downstream transaction and that it isn't a realized profit, but we tend to stay away from those kinds of discussions when we're looking at standard setting. So I think I think it's a really I think if you disagrey with the first decision that actually we shouldn't have eliminated the eliminations, then I think then that needs to be articulated. But when you come to answer the next question, you know, on separate financial statements, I think you need to explain why the consequences of using that method in separate financial statements, because whilst I think we will have discussions with the board about separate financial statements, I think we've heard general support for eliminating the eliminations. So I think it will be more, if during redeliberations, I think we're going to not have as much evidence to support changing our proposals on the eliminations, but we might have more evidence to support changing proposals on the separate financial statements. So I wouldn't answer question 8 by saying, well, we disagree with question 4 anyhow. I would still set out your arguments on separate financial statements. I took a long time to say that, sorry.
Okay, Jose Luis is raising the hand.
Yes, thank you very much. Hi, everybody. Well, I think we have two important points here. One is that we are going to have the consolidated equity different from the individual equity. And the consequence of it, Michelle, is that in accordance with the legislation under here, the basis for dividend payment is the equity at individual and not at consolidated basis. And so it will cause, of course, differences or conflict with the statutory law. So in order to keep going with that, we should change the statutory law. Otherwise, we are going to have problems. And the second point I concur with Hernan's view is that in many cases, the controlling part will define the value of a transaction. Perhaps it is not necessary on an arm's length basis. So the regulator usually looks into it very carefully, and it may represent that we are given opportunity for earning management. Perhaps So, I think that the most important point is the first one, that when we have different sets of accounts for the same entity, and is very very close to the statutory law that views it as only a single entity with two sets of of accounts representing the same thing. So we are not going to have this anymore. So that's something that we have to digest. I don't know if we have it in other jurisdictions. And what would be the consequences, as you ask for, is that we are going to have some conflict with the current legislation in this aspect. That's it. Thank you.
Just to take the point that Jose Luis mentioned, and also I believe Michelle mentioned about the role of the separate financial statement among jurisdictions. I understand that maybe to modify IAS 27 could appear as out of the scope of this project, but I understand that the scope of this project was not to modify the current status in those countries that use the separate financial statement in any way. And with this change, you are really changing the rules in those countries where the separate financial statement are currently used to different realities. That's why we think that it's correct. We have to discuss more broadly the purpose of the separate financial statement, but meanwhile, we could try not modifying the current situation, because the purpose of the IAS 28 project was not to change the rules in those countries using the separate financial statement in some particular way. That maybe could be an argument. Meanwhile, we are open to discuss more broadly in other projects the purpose of the separate financial statement as a whole. We can try to maintain the current status of the separate financial statement. I understand that maybe it cannot sounds as a technical argument, but it is practical argument rather than technical, because this is really a deep change in many of our jurisdictions.
I think I agree with you that we need to look at this. How we look at it is going to be based on the comment letters. I don't think. Well, I think the board has learned temporary exemptions don't work very well in IFRS. They tend to be long exemptions, unless you define temporary as being something over a decade. And I don't think, if I'm honest, unless it comes up in the agenda consultation, which of course, you'll be preparing for because that's next year, that the board would be keen to take a project on separate financial statements. So I think, putting alternatives in the comment letter, like putting in a temporary exemption and sort out separate financial statements, is one option. And actually, having two equity methods, or having an exemption in the equity method are other options. I think it's not gonna hurt putting in all of your ideas in that comment letter, and we can work through them in the analysis. I was saying earlier today, what we are thinking about as staff is that we take the comment letter summary to the IASB in Q2, and then we will probably go away at the beginning of Q2, and then as staff we plan to go away and probably not come back until the end of Q3, so that we have time to actually look at all of the feedback and engage with people who have got feedback. And one of the comments that we've had is we answered the questions in a very piecemeal fashion, and I think Filippo and I agree with that. We were like, just answer this question and move on. And we'd like to look at the interaction across the questions a bit. So I certainly think the more you put in your comment letter, the more that will help us look for alternative ways of resolving this issue for you.
Okay, will do.
Can I just ask a question? The concern is only about the intra-group eliminations. I mean, let's assume that we would consider to say, okay, the entity in the separate financial statement applies IAS 28, except for. The except for would be the elimination, keeping the elimination, or it would be some other except for this, except for. I mean, for instance, let me think of something. When I buy a minority interest of a subsidiary, I put the difference in equity between the price and the non-controlling interest, right?
Right.
Okay. When you purchase, when you use the equity method for that subsidiary in the separate financial statements, do you also debit the equity? Or no? I mean, that's what I'm saying is that is the only difference would be the different treatment of the eliminations, or there would be also other aspects of the equity method that you think don't work in the separate financial statement. That could be useful if we could have this more precise indication.
In this case, Filippo, I understand that there are different practices among countries in Latin America because, for example, in the case of Argentina, in the separate financial statement, we present the difference in profit or loss, and in the consolidated financial statement, we present the difference in equity. But I believe that in other countries, practices are different to those in Argentina. But I'm not sure if the group was talking about the list of exemptions to add in IAS 27. No, so far. Okay. What I am sure, because at the level of the board we were discussing about this point, is our concern about intra-group transactions. That it's sure a point that we have in to address in this topic. I understand that on the other topics, for example, the treatment of the change in the minority interests could be different country by country, and maybe we cannot arrive to a single opinion into the GLENIF, but yes, for this other topic that is similar country to country.
Because obviously you have to deal with a potential exception is one thing. It's a list of 10 things. The more the more difficult you can't have, like, if you apply IAS 28 apart these 10 exceptions, it becomes a little bit more difficult.
I can.
That's why we wanted to understand, because you did mention try to keep the current status of equity method. So we wanted just to understand, what does it mean, current status? Current status means equity method as proposed in the exposure draft except 1 or 2 items, or equity method as it is now in IAS 28? I guess that's
the first one. The first one, because in practice, most of the proposal in the project are the current practices that companies the companies apply. But in this case, we are creating a big difference between the current practices and what the companies would be required to do in future, not as it is. But just a comment, in the past, for example, for many years in Argentina, we did not adopt the IAS 27 as it is. We adopt the IAS 27 and applying, but not the equity method as it was established in IAS 28. We adopt the IAS 27 with the add requirement that we need to include any amount that ensure the similarity between the result in the consolidated financial statement and the separate financial statement. Because at the end of the day, our main concern was that we need to treat the result of the group, but using the financial statement of a legal company. Because under our law, a group is not a legal company. A group is just an accounting reporting entity.
Okay, I think that I think maybe we can move to in the interest of time, because
Yes.
I don't know if there is any other comment, but I think yes, this is quite clear. So, well, in terms of the impairment indicators, well, basically what the board tried to do was to modernize a little bit the language in IAS 28. There was some of the indications in IAS 28 that were using some old language. Specifically, there was this reference to a significant or prolonged decline in the fair value below the cost. This was language that was used in IAS 39, and it was used for available for sale financial asset. So it was a completely different model for value through OCI and less impaired. The board is basically has revised the language, so it has aligned the language to IAS 28. It has removed the reference to significant or prolonged decline, and has replaced cost with carrying amounts. There is no change in the way, if the entity concludes that there is an impairment indicator, they have to do an impairment test under IAS 36. This has not been changed. So the effects that we expect is not that there will be more impairment, but there may be, I mean, some companies may need to do an impairment test more frequently than before or earlier than before. On this one, I think that generally we have not heard a lot of comments. Obviously, some preparer is saying, well, if you remove the significant or prolonged, I may have to do some more impairment test, which we see that is a normal implication. But I think that maybe what I notice that people really focus a lot about the significant, taking away the significant or prolonged, but the fact is that IAS 28 has now a number of impairment indicators that need to be considered collectively in order to see whether there is a need to proceed with the test.
Any comment or reaction to this point? No? My personal view is that in practice, the change or the modernization of the wording in the standard not necessarily increase the need of testing the investment, but at least I never hear about that, but maybe some could have this perception in practice. I'm not sure.
I think an interesting comment we heard was from one of the firms that said, if I'm not mistaken, we should just drop everything from IAS 28 and just tell people to apply the indicators in IAS 36. They say, why do you even need additional indications in 28? Just tell people to use IAS 36 for everything.
I thought that was a good idea. I was quite open to that idea. Just say, do an impairment test and apply IAS 36. Why do you need these additional points in IAS 28? Just like get rid of your significant and prolonged as well. Yeah.
Yep. Could have been an idea. We didn't want to change too much, but yeah, in a way, it's not It's not a bad, it was not a bad suggestion, to be honest.
No, I don't think it was a bad suggestion, that we felt a bit guilty not thinking about it.
Okay, so maybe we can we move to the transition, because I think this is where I would be interested in hearing the views. Okay, so the transition, for most of the proposal in the exposure draft, the IASB is proposing to apply them prospectively, so only to things that happen after the transition date. The two things that we're telling people to do at transition date is to first to adjust any contingent consideration. Many people already use fair value for their contingent consideration. They will not have to do anything. But if somebody was using a different measurement, or they were not recognizing contingent consideration, that would be adjusted at fair value at transition date and adjust the investment for the same amount. The other thing is about the previously restricted portion of gains and losses from the upward and downward transaction. And we are saying, and maybe it's not written in the most clearest way in the exposure draft, basically people have to adjust this amount directly in retained earnings. And I think on this one, we are hearing some comments. People are saying, we may not have the information, so we may not be able to do it, so you should let us do it prospectively, or consider some kind of transition relief. I'm a little bit, I'm not completely sure to understand, because people are saying we don't want to go back 10 years, 15 years to find these amounts because we didn't keep track. And my point is that this is only about the unrecognized portion. So if you sold something to your associate 15 years ago, I would expect that this inventory has gone out, and so there is no remaining unrecognized portion. But I don't know if you heard this kind of comment as well in your jurisdiction. People are saying, well, there are cases where we don't have this information, so we don't know how to do it at transition date.
Any comment on this point?
No.
As I mentioned during the EEC meeting, I believe that the requirement on apply the eliminations in retrospective way should be stated with a requirement of impracticability, because for many companies obtaining the information from many years ago could be really impracticable. Indeed, to analyze if these are really realized profit or losses could be difficult, because the year when the transaction occurred, maybe it was an unrealized transaction eliminated, but in the other year that was recognized as part of the profit or loss of the group. And we are creating the need to track all the transaction along all the life cycle of this transaction, not just the year when the transaction took place. Oscar?
Mm-hmm.
Yes, thank you. I just want to make a comment in the transition point. And this comment is related, unlike contingent consideration and the recognition of the gain or losses of transactions with the associate, all the transition requirements are applied prospectively. But I'm just curious about one of the requirements in the exposure draft, which is the recognition of losses, part of profit or loss. The first part is in profit or loss. The second part is in other comprehensive income. I'm just wondering if that specific requirement also shouldn't be applied retrospectively, because I'm thinking of maybe an associate where I suspended the equity method recognition of losses because of my investment isn't zero, but should I also go back and maybe kind of reclassify the recognition of losses between profit or loss and other comprehensive income, or that requirement transition is not considered in the proposal? Because I'm thinking maybe it also could be a change.
Well, we've had this question raised to us, and we will probably think about it in redeliberations, but and we also had it in relation to if you've got unrecognised losses and a carrying amount of nil, do you need to recalculate your unrecognised losses? But I think my gut feeling would be it's a kind of, it would be difficult for that to meet the cost benefit test. So
Okay.
I think we will think about it, but my initial reaction is, seriously, do you want to do that?
Oh, no.
The first question you were raising, that would be just a reclassification between retained earnings
Yeah, but
and
you'd have
cumulative OCI, so it wouldn't have any impact
yeah, but
on
you'd
the.
have to go back and recalculate.
No, but I'm
Yeah.
saying even if you did that, it would be just a reclassification
Yeah,
between
it would,
retained
yeah.
earnings and cumulative OCI, so it would not have an impact on the equity, would not have an impact on the carrying amount of the investment. I'm trying to see why it would be useful. Is it for the recycling part in future? Well, what would be the benefit? Because it doesn't change the equity, doesn't change the.
Of course, it doesn't change anything, and it might be more a matter of reclassification. As I'm sorry, as the lady with you said, I'm sorry because I'm very bad with the names. But
Michelle.
Michelle.
Yeah.
Michelle said, what is the benefit of recognizing or reclassifying losses in an investment which is zero in value? But what about the investment that maybe are not zero in value, and maybe the user of the financial statement might actually gather some information from this reclassification, whatever. So again, I'm not seriously talking about you guys put this the requirement to apply retrospectively. I just had this curiosity, and I just want to raise a question to let you know.
No, we have heard it. So I'm sure we're going to get it in comment letters. So we will have to think about it. Yeah.
Maybe, because like recognition of contingent consideration and the recognition of the gain on losses, I also thought that this requirement also could be probably applied retrospectively. That's it. That's my point.
But again, just to make sure, retrospectively doesn't mean that you have to recalculate going back years. It's just a transition date. It's a catch-up adjustment at transition date. Maybe we can explain it better, but we're not asking people to go back and make calculations from 10, 15 years before the transition date. They just have to adjust the number at the opening balance sheet. That's it. That's all. So I think we've really tried to make it as easy as possible to be applied.
Exactly. Just make the easiest possible, but also keeping the useful of information in financial statement in check. That's what I meant.
Okay.
Thank you.
Thank you, Oscar. Any other comment? Well, do we have any other point, Filippo, Michelle, in the presentation, or we have covered?
No, on the disclosures, as I said, I mean, if you have any suggestion to improve again, I think also on that additional disclosure, I think the board has been very careful about not creating too much burden. So they just introduced, I think, a few new disclosure requirements in IFRS 12 in order to facilitate people to understand the effect of the new requirements. For gains and losses, the board decided only to require the disclosure of the downward gains. And this because we've heard from preparers that it would be difficult to go to the associate and ask them to give you the amount of the upward gains. Some people, well, I would say that we heard some comments yesterday from the European regulators. They said, no, you should also require the disclosure of the upward gains. Some preparers would also want not to disclose the downward gains. So sometimes when people complain on both sides, it means that we maybe have struck in the right balance. But I would say that there have been not a huge amount of comments on the disclosures.
Any Oscar, you're raising your hand again? No. Oh, okay.
Oh, I'm sorry.
Okay. Any comments on the disclosure proposals? Well, I think we don't have more comments. We waste all our comments on the separate financial statement topic.
We focus on
With all our energy in this topic, yes. Okay. Well,
I think I'd like to say thank you, because I appreciate the time that you've set aside, and I also wanted to say I do hear the sensitivities, and I think in 6 months' time it would be good if, when we're developing the board papers, we can work with Tadeo and yourselves to help us make sure that you're content that the board papers reflect the views that you have.
okay, we will be very grateful for this, Misha. This is very helpful for us. Thank you. Well,
Thank you very much, and
Merry Christmas.
Feliz Navidad.
Merry Christmas.
Thank you.
Feliz
Merry
Navidad.
Christmas.
Merry Christmas.
New Year.
Have a peaceful and happy new 2025.
Happy New Year's.
I hope that the new year find us working together for the accounting information around the world, anywhere we are. And well, thank you once again for your willingness to share with us your time, and for hearing from the Latin American standard setters our visions and our concerns on your ongoing work. Thank you once again, and we are keeping in touch, and see you sharing in other opportunity. Meanwhile, have a happy new year and Merry Christmas to all here and all following us in YouTube also. Thank you.
Thank you.
Thank you very much.
Gracias.
Gracias a todos.
Thank you for all.
Feliz año.
Merry Christmas.
Merry Christmas.
Gracias.